This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we're very pleased to welcome on Jacob Vanderslice of VanWest Partners to talk about an asset class that we've definitely had some exposure to on this podcast and as a broader sense on what we do on the professional side at Advanta IRA, and that's self-storage. A lot of people that are looking to get into the commercial real estate space, you kind of get attracted to the big sexy items of the apartment buildings and, different type of mixed use stuff. But there's really awesome opportunities that are going to be afforded to people that are looking at the self-storage space, because when you look at it from a very holistic point of view, you're not dealing with tenants, toilets, termites. You're dealing with people's stuff, right? So the utilization of these types of properties is a significant attractant to a lot of people, and especially from the investment side of just, how you can package these things together, buy them. It's typically going to be a cheaper type of property to buy. There's not as much things to put into them. And again, I find them very attractive from a lot of different viewpoints. But the problem is that with the changing landscape of all of our investment viewpoints in the United States, is that just like with everything that's happened with commercial real estate, single family, or really any investment, even looking into the securities world, everything is really changing. What penciled maybe last year is definitely not going to maybe be the same workup as this year. Something that's penciling perfectly 4 years ago certainly probably isn't working out so well, because if you're trying to package that deal together in today's current landscape and environment. So we're going to talk about a lot of stuff today. Again, Jacob, thank you very much for being on with us. Really looking forward to diving into this. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be your current position with VanWest.
Yeah, Alex, great to be here. We've had a couple kind of preliminary calls leading up to recording this, and it's been fun getting to know you. I'm excited to talk today. I'll be brief here, but we've been investing full-time in real estate since about 2006. And we got started in the single-family residential space. We did a ton of fix and flips all over the country, mainly in Denver. But we had a couple other target markets we opened up and operated pretty heavily in. And along the way, we've done some townhome developments, some multifamily, some adaptive reuse, kind of historic preservation retail. We've done some industrial deals, some land deals. So we've covered a lot of food groups in the storage space. And as I look back, one of the problems with our business on many levels was we were being kind of overly transactional. We were buying and we were selling too often and too quickly. It's not tax friendly. It's kind of an eat what you kill strategy to a degree. And we wanted to shift our thesis to being more cash flow focused and accumulating and building a responsible cash flowing asset base that we can hold for a while and eventually monetize when we feel like it makes sense to monetize that value creation. We thought storage was a good vehicle to do that. And we did our first storage deal back in 2015, and that was a ground up development project. And at the time, it wasn't really a strategic pivot into a new asset class. It was more, let's try a deal out and see how it goes. We did a few others thereafter, and they went okay also. So we kind of kept going. We launched our first fund vehicle in 19. Leading up to then, it was all single asset investment vehicles, single asset syndications. Fund 2 was 21. We recently closed up Fund 3. As of today, we've got, I know it's kind of an oddly round number, but we've got 40 properties totaling around 20,000 units and just over 3 million square feet. Most of the deals that we'll do are value add existing facilities that are simply inefficiently operated. We'll occasionally do development projects. Those are fewer and further between, just given the state of the capital markets, the risk profile, the risk return profile. So we'll generally target deals that are mom and pop operators. They don't advertise well. They don't have online marketing. Their rents might be below market. Their expenses might be above market. We'll buy those. We'll renovate them to varying degrees depending on the quality of the asset. And most of our value creation will really come from operating it more efficiently through our property management platform. So that's what we're up to.
Okay. Gotcha. Yeah, great. Just making a few notes here. So, the best place to start with any story is kind of at the beginning, right? So, you have, again, a general, it's kind of a mixed use, again, bag of what you were doing in real estate, starting back in 15 and then going up into, I believe you said 19 is when you had, was it 19 or 15 that you had the first stab at storage?
First storage deal was in 15, and from 15 to 19, we probably did roughly 10 deals, but those were all kind of single asset, individual investment vehicles. And then 19 was when we launched our first storage fund. So been in real estate since '06, been in self-storage since 15.
Gotcha. So with that first one that you did in 15, you mentioned that that was more of a ground up development deal. So, what are some kind of lessons that you learned? Because it now sounds like that, again, you're positioning yourself more towards the value add, finding inefficiencies in certain assets, acquisition, reposition, cash flow kind of being the mantra of what you're doing now. But, ground up development's kind of a, kind of a big leap to take into any real estate project for your first stab at that asset class. So what are some kind of lessons that you learned, doing that back in 15 that kind of made you say, okay, great, this did or didn't work, and then why you're kind of transitioning in what you're doing now of, again, the value add prop as opposed to the development prop?
Yeah, I love talking about bad deals and failed deals so much more than I do the successes, because that's where you learn. That's where you can apply lessons. A lot of the successes, yeah, there's some execution and some operational excellence you have to make a deal successful. But sometimes you just get lucky, right? It's market timing. You refinance at the right time. You sell at the right time. So our first deal going into it, we didn't know, but we didn't know, right? We'd never been in the storage space. We had studied it for a long time. We understood development. We understood real estate. We understood rents and NOI and cap rates and IRR and multiple. We understood all those metrics very well, doing lots and lots of deals for many years. But it was our first storage deal. And the first one we did was a development project here in downtown Denver. And it was an off-market deal, kind of a busted, very old 3 or 4-plex, 120-year-old brick building just southeast of downtown. And what we didn't appreciate at the time is the impact of new supply. So we had this idea to build a storage facility. And what we weren't tracking and weren't thinking about was the fact that a lot of other folks had the same idea at the same time. So we built this deal. We came out of the ground. We started leasing up. And a bunch of other projects came online. And for a long time, our occupancies and our rents suffered because of that supply shock issue. And today, I often say we get a little bit stupid every year. A little less stupid every year. So we'll be a little bit less stupid here about 2 months from now. But we didn't know what we didn't know. And now we appreciate that a lot more. So that deal was part of a programmatic joint venture that we did with a real estate office here in Denver, also backed by a life insurance company based out of Texas. And we did a total of 9 deals with them. And we sold them all to a large REIT in the middle of 2022. Again, I'd rather be lucky than good. That was good timing, kind of right on the precipice of this run up in interest rates and kind of a changed market. But in aggregate, those 9 deals did well. But because of what we did with allocations on the sale and a number of other reasons, that first project we did not do well. The whole portfolio made a good profit, made a good return, but we just did not appreciate at the time the impact of new supply. And then the second thing we learned too, and again, we're slow learners, so it takes a while for this stuff to sink in. And I guess this may not come as a big surprise as I say it out loud, but we learned that third parties don't care about your deal as much as you do, right? So we had hired the REITs to manage these properties when we got into the business because they're best in class. We didn't know what we were doing. They've got dazzling marketing and revenue management and brand exposure and web presence. And we found over time that to a large degree, our interests were kind of misaligned. So there's a lot of ancillary income streams in self-storage, like tenant insurance, that many of the REITs will keep for themselves and not share with their third-party owners. They've also got very bloated marketing expense loads. You might spend $30,000 a year in marketing on your store, but you can't necessarily defend that those dollars are directly driving customer traffic to your location. So as the honeymoon kind of wound down with our third-party management company, we realized that our interests were kind of misaligned. And over time, we started self-managing our portfolio, not because we're smarter or better, but because we care a lot more. And we're going to fight for that $1,000 HVAC invoice. We're going to fight for rebidding the snow removal contract every year to get $5 or $10,000 off that contract. And we started self-managing over time and taking those deals back from the REITs and then self-managing the properties that we bought in the future. And so I think lessons learned on the first deal were really appreciating and understanding and quantifying the potential impacts of new supply coming online. And then secondly, realizing that giving the keys to a third party does not always create a good outcome.
Yeah, no, those are two really kind of good points. I don't really think I've really fleshed out with any of the other people that have been on, any of our platforms for talking about self-storage. And it brings up a few good points because unlike, your more traditional multifamily where, the acquisition team, the GP typically isn't going to be necessarily, in many cases, really going to be very hands-on with the management. You're going to typically always farm that out. It's kind of par for the course. There's very few, at least I've run into, that also have ancillary management that maybe is kind of quote in-house. But most of the time, if you're dealing with 300 doors, it's again, there's a lot of things that are just easier if you're looking at the investment side to have a quality manager. But on the self-storage side, there's a lot less going on. So again, I would think that, coming in, especially like you're talking about, like, the REITs coming in, and it's a little bit more of a marketing play than really management. You get people in, get their stuff in, someone's old sofa in credenza doesn't call to complain that the air conditioning's not working or something like that. So that's definitely kind of an interesting thing to kind of flesh out a little bit more. So on the initial rip, you were saying, okay, we're going to kind of focus on that acquisition, what do the metric numbers look like? And then the management is really kind of maybe one of those things that you didn't realize was as important to maybe kind of keep the keys to the kingdom for. So with regard to that, you're talking about things like bloated marketing expenses and just kind of the cost basis it had to have some of those partners come in. So on maybe some of your next deals, how do you start to kind of claw that back? And, do you take over all management now on these new acquisition deals, or do you still farm some out? What's kind of the happy medium, and where did you find the most success on the management side of these assets?
Yeah, we self-manage everything that we own. So anything that we buy, we'll put it under our brand, which is Clear Home Self Storage, and we've been doing that for years. We don't third-party manage any deals, meaning we only manage what we own. It's a painful business. It's very low margin, and the amount of time that we spend on it is just not worth the kind of pittance income stream that third-party managed deal will produce. So we only manage what we own. And I do want to expand briefly on one point that's kind of related. I'm not saying you're incorrect a few moments ago, but we often hear from folks that, hey, self-storage, no tenants, no termites, no toilets, no problems, whatever the sayings might be, as it relates to multifamily. And there are certainly differences that are much more attractive between storage and multifamily. I mean, you've got fair housing laws. You've got instead of having 300 kitchens and bathrooms, you only have one bathroom and a break room. However, with that being said, I don't want to diminish how operationally intensive self-storage is. So somewhere right now in the country, we've got, call it 20,000 units. I guarantee you someone right now is breaking into a unit. A U-Haul is backing into one of our $30,000 gate systems. We have a customer that's probably storing drug money somewhere or drugs. We're going to get searched or served a DEA search warrant. That probably happens once a month. We constantly are having operational challenges because we have hundreds of customers moving in and moving out every day. We had a lady drive her car last week into her storage unit, which she's not supposed to do, and then close the door to the storage unit. And those doors are a one-way door. Once they close, they latch on the outside, and she got stuck inside. She's fine, thankfully, but we had to she called the fire department. They came and cut the door open. It was a whole thing. We had to do an incident report. So it is operationally intensive, and you need a team, regardless of whether you're doing storage or some other real estate asset class. So much of the value creation in real estate investing is going to come from your ability to grow net operating income. And for those of us listening that probably heard of that term before, net operating income, or NOI, is purely gross income minus expenses. And in real estate finance and strategy, that's where the rubber hits the road. Whether you're doing a development project, you're buying a multifamily value add, whatever it might be, the crux of what you're trying to accomplish is to grow NOI. That's what all of us are trying to do, grow NOI by increasing rents and occupancy and controlling operating expenses. And that's where you create your value. So when you're looking at your operational platform, whether it's a third party or you're self-managing, that company's ability to grow that NOI is extremely important. A couple things to actually answer your question from a moment ago. You talked about some ancillary income streams. I'll give you a few examples of those. So in multifamily, Examples of ancillary income streams are like resident utility bill backs. Like you might buy a building where the landlord was paying for all the electricity. The new buyer repositions the building so that each unit's separately metered. They bill the resident for their electric bill on each unit, and that expense comes off of their income statement and goes on to the resident. They grow their NOI over time. Late fees is another one in multifamily. Pet rent, pet deposits.
Parking.
Yeah, and self-storage, our ancillary income streams are, some of them are kind of similar to multifamily, others are very different. We have obviously late fees. If you pay late, you get a late fee. We have some customers that pay every month, 10 days late, and they pay their late fee. And we want them to pay on time, obviously, but we're okay with that because we make a little bit of money off the late fees. You have administrative fees, which is a one-time fee when the customer moves in. You've got U-Haul truck rentals. We do a revenue sharing agreement with U-Haul in a number of our locations. We oversee the operational aspect of renting the truck. U-Haul owns them. We take a piece of their revenue sharing. But the big one, I would say, in our business that moves the needle most is our tenant insurance. So a lot of folks are kind of surprised to learn that in self-storage, it's customary for the lease to stipulate that the owner is not responsible for the contents of the unit. So even though the tenant is leasing from the owner and leasing in the building, if there's a fire, theft, or flood, the owner is not responsible for any loss on their contents in their unit. So we require
When you
that.
say, just real quick, when you say owner, you mean the person renting the unit is not responsible?
Sorry, forgive me, the owner of the building, which in this case,
Okay.
yeah. So it says that, hey, tenant, thank you for storing with us. In the lease, by the way, it says that, if there's mold or a flood or a hurricane, whatever the case might be, we're not responsible if your stuff gets damaged or stolen or goes away.
Okay.
So we require our customers to either present proof of coverage on their homeowner's policy. We put that on file, or they have to buy what we call a protection plan from us. And it's not too dissimilar to, for example, car rental insurance. So if you're traveling, depending on the salesperson that's at the front desk when you rent your car, they're probably pushing that insurance pretty hard on you because the margin is enormous on that insurance. And you probably decline it because you've got it on your auto policy or you've got it on your Chase Sapphire card. It's similar in the storage business. So we will pay our carrier about $2 a month per unit, per occupied unit. And we'll charge our customers between $12 to $20 a month, depending on the coverage amount. So let's just net that out and make the numbers kind of round. Let's say that we're netting $10 per month in insurance revenue. That may not seem like a lot, but when you amortize that across thousands of units, then you annualize that, then you put a cap rate on it, you've created a lot of value just by slinging that little $10 net income stream protection plan to your customer base. So I think through the end of September, I'll have to look at October numbers, but we were averaging about $140,000 a month in tenant insurance revenue. And that's a meaningful component of your income stream. So all of those revenue streams I just described year to date comprise over 10% of our top line revenue. So if we buy a deal and we do nothing else in the first year, a deal that lacks those revenue streams, and we certainly endeavor to do a lot more in the first year, of course, but if we do nothing else, we can generally grow revenue by 10% just by charging late fees, administrative fees, merchandise sales, doing U-Haul truck rentals, and then increasing our tenant insurance protection plan penetration within that facility. And one kind of eye-opening thing, as we learned how meaningful that insurance revenue was over time, we looked at how much the REITs were making off of that insurance revenue that were third-party managing our stores. And that's a big piece of the revenue stream this asset class produces that they were keeping and not sharing with us. Good for them, but not great for us. And that's one of the many reasons we started to self-manage.
Yeah, no, those are all great points. And again, I'm always happy to learn something, whether by, what other people have kind of conveyed to me or kind of my own assumptions about it, that, management being, maybe the correct way to kind of look at it is that, it's not necessarily easier per se, but it's different. It's kind of an apples to orange comparison when you say, hey, look, here's what your management overhead and exposure is for dealing with 300 individual tenants living in your units. Well, just because they're not living in there doesn't mean it's necessarily easier, but it's going to be different. You're not going to have to, typically someone's not storing massive amounts of drugs in their apartment and, like that. They're not backing in their pickup truck into the big gate at the apartment. It's like, things that, could certainly happen do happen here, whereas they don't here. And it's just kind of picking up the delta between the two and saying, okay, this is different, not necessarily easier. And I think that's a really good thing for investors to look at too, because it's always important to go in, feet first and eyes open to any type of investment. And just because maybe you're tired of saying, look, I've been investing in the commercial multifamily side for so long, here's all these issues, it's got to be just easier on the management side to go to self-storage. Well, again, maybe not easier, different concerns, very big concerns that you have to look at, are some things to kind of gather from that. Now, again, I think what I'd like to expound a little bit more again is the additional revenue streams and kind of capturing that, because the amount of things that can kind of go on with that are great, but how really does that, I believe you said it was about 10% of your kind of NOI was based on additional net revenue streams from like insurance and other things. Was that roughly accurate?
Correct. Yeah.
Okay. So you have your additional revenue streams coming in, but where kind of the big meat of this, how do you kind of control, again, rent prices? How do you necessarily set those things and determine what is going to be a marketable rent rate, and then capturing those revenue streams when you're looking at things like, okay, how much did we sink into redevelopment costs? What is our top line management going to be for all of this? That's, again, what I find to be kind of the tricky thing, just coming from, let's say a civilian, I've never personally invested in self-storage. I've utilized it. I've been a customer of it a few times. And, again, it is so, like, you look at 10 different places, you get kind of 10 different answers on what you're being charged. And like, I would like to understand a little bit of how you kind of go through determining that. So maybe kind of let's start at the, reposition factor, and then go into building out, the management and ultimately what is the price point model for this stuff.
Yeah, I'll talk about revenue management first. Before I do that, when I hear someone's been a self-storage customer, and I'm kind of leading the witness here, so any answer is fine. But
yeah,
here I ask, when you stored in that unit, did you store in that unit for longer than you thought you might be in that unit for?
We're probably one of the weird people, because it was really exactly as long as we thought it was going to be. We had an apartment where we couldn't store the stuff, and we were like, we would really like to own a house. Got our rental house in about 14 months after we lived in that condo, so it was pretty short lived. I would say we're maybe 2 months over what our initial. I think we did like a year, and then month to month for 2 months before we got out of that.
So Alex, you could have just told me a little fib there to help me reinforce my point, but that's totally fine. So you're kind of an outlier to a degree. So a lot of our customers will move in, and they think they're going to be there for 3 or 6 months, and 18 months, 2 years later, after a couple rent increases, they're still in there storing.
Yeah.
And it's kind of an out of sight, out of mind thing. It ACHs off of their bank account, or it auto drafts off their credit card. And it's enough to kind of be annoying, but not enough for them to take action.
Sure.
So the fact that all of our leases are month to month does not mean that our customer base is not sticky. It's very sticky. Most people stay there for a lot longer than they anticipate. We haven't owned the deals for this long, of course, but we have some properties that we've owned for 2 or 3 years, and we'll buy them, and we'll look at the rent roll, and we'll find customers that have been storing there for 10 plus years. And whatever they've got in that unit, by the time you figure out 10 years of rent against the value of the contents, they probably could have bought more stuff, several times over.
Mm-hmm.
So we talked about 10% of our revenue being ancillary. Obviously, the other 90% of our top line revenue, roughly, is coming from rent. So how do we grow revenue in addition to getting the ancillary income streams increased? So we do it in a couple different ways. We'll, not unlike any other asset class, we'll take an empty unit and we'll put a paying customer in there. So we're taking zero revenue to revenue. And we're also taking existing customers and we're increasing rents over time, depending on the unit type. And what we're looking at, first of all, revenue management and self-storage is very granular. We're looking at thousands of units, and to a degree, each unit type is kind of its own product. So if you've got a facility, so we have a development project, for example, that we opened up in Longmont, Colorado, north of Denver. We opened it in January. It took us about 18 months to build it, started leasing in January, which is, by the way, not a great time of the year to open a storage facility. But let's say it's got a couple hundred 10 by 10s, for example. That's one unit type. You're not going to assign one price to every 10 by 10. So some of them are climate controlled, some of them are drive up, some of them are interior access. So a 10 by 10 that might be right by the front gate, where you can drive up to it and load and unload, is going to command a premium over a unit where you have to put your stuff on a cart, walk down a climate controlled corridor, open a door up, put your stuff in, and kind of rinse and repeat. So the revenue management is very, very dynamic, and it's very granular. And we're constantly responding real time to supply and demand changes at the unit level, the facility level, the submarket level. So let's say we look at a customer who's been in there for a year and they're paying, say, $100 a month. And maybe it's a 10 by 20, which is a decent size unit. Chances are, if you have a 10 by 20, you probably have a lot of stuff in there in most cases. And let's say that market rents on that 10 by 20 are $120 a month. So they've been there for a year, they've been sticky, they're paying on time. And we're looking at comps in the submarket, and we're saying, all right, 3 or 4 miles away, there's another 10 by 20 for $120 a month. We could bring that customer up to maybe $115, maybe up to $120 to match market with a 1 month notice. And that customer is probably going to stay in that unit, because if they still need storage, they're not going to take the time on the weekend to rent a truck, call up a buddy, move their stuff 3 or 4 miles away just to pay the same price. So that's one of the big ways that operators will create value. Our existing customer rent increases, or ECRIs, is the industry jargon abbreviation. So ECRIs are really done in different ways. It depends on the unit type. It depends on how long the customer's been there for. When we're buying a deal or we're underwriting a potential acquisition, I think you asked us a moment ago, but what are we looking at from a just general fundamental perspective? Well, we're looking at the normal real estate fundamentals, right? Location. We want a story for population growth. We like to see submarkets with density. But we're also looking at something called supply ratios. So we're analyzing the square feet per capita in that submarket. So how many square feet of storage is there per person, say, in the 5 mile trade radius? Nationally, there's about 8 feet per capita. And some markets are much higher than that. Some markets are lower. And you might think if you're buying in a market that's, say, 20 feet per capita, that might be oversupplied. That's not necessarily true. What we're looking at is not so much the supply ratio as it relates to the national average. We're looking at the supply ratio in that submarket and where it's been historically, where occupancies are, what the supply pipeline looks like, and what the risk is of that supply ratio materially increasing over a short amount of time. So we're looking at the impact of new supply. We're looking at the supply pipeline. And obviously, like any other real estate investment, we're looking at rents. We can buy a deal where the operator is not marking their rents to market. They're not advertising. To borrow my example earlier, maybe they're charging $100 a month for a 10 by 20. The market in the area is $120 a month. We can be pretty confident we can buy that deal, start marketing, and start incrementally raising rents over time to see that NOI growth come out the other side and create value. So really, the square feet per capita and supply ratios is kind of the main non-standard real estate metric that we're looking at. What's coming in the pipeline, what's the current supply, and what is the risk in the short term, medium term of that supply materially increasing. And then we're layering those assumptions into our model, and we're making a go, no-go decision on the acquisition.
No, and those kind of make a lot of sense. And one thing that, you mentioned earlier was kind of supply shocks. And that is something that, I'd imagine is probably one of the main things to look at from the people that are doing the redevelopment plays. That can be kind of hard to, determine, because you're really trying to make that determination when you're talking about the square foot storage per capita. You're coming in with new supply that's going to give you it's going to change that formula. Whereas with this, it's definitely more of a repositioning play on saying, okay, look, we're not changing necessarily the supply. And I have kind of a question to that. We're mainly, kind of saying, look, there's a delta between what is being charged and what the market can support, which again is kind of, easy for a lot of real estate investors to understand, right? You buy a house, okay, this person was paying $800 a month for the past 20 years. I'm going to come in, rehab the property, and now it rents for $1,500. I think that's, a very easy thing for people to kind of get their head around, which is nice because a lot of this stuff is pretty different. You're talking about looking at an equation of storage per capita of a particular market, that definitely bears some investigation by the investor to say, okay, how exactly does this play out in, my investment thesis to make sure, okay, I'm being protected and this is a worthwhile play for me. So when it comes to what you're doing right now, again, being more of the acquisition reposition, there's a few things that, I'd like to maybe get a little bit more information on. One, when you come in to do the reposition, is it mainly just a change of saying, look, we can charge X amount, or what are some kind of improvements that you do besides just looking at, rent rolls and things like that? Do you maybe go in and structurally change the sizing of units? Because like you said, the larger units might have stickier tenants. If you have one that basically just has like a 3 by 3 units in the entire thing, like how much actual I guess for lack of a term, like how much actual rehab would go hammers, drywall, like how much that kind of stuff actually goes into this, or is it a lot more on the operational side of things that you utilize for your reposition plays?
Yeah, it's definitely more on the operational side. On the actual rehab side on the front end, we'll occasionally do. So we have a deal in Jacksonville, Florida, for example. We bought an existing storage facility and we're building an additional 28,000 square feet of new self-storage units on the excess land. So that one's a heavier value add, obviously big capital improvements there. We have a deal in Green Bay, Wisconsin that we closed on in June of 2023, and big property, but in pretty rough shape. It was suffering from a lack of marketing, a lack of kind of upkeep, below market rents. So we put about $1 million into that deal. We didn't add a single square foot to it, but that $1 million roughly went to seal coating, replacing the asphalt, new roofing systems. We swapped out something like 800 roll-up doors, which is not easy to do because a lot of those units are occupied. You're disrupting the customer. But some of these older door systems will kind of be sticky. They won't go up and down like they're supposed to. It's just not a good customer experience. So it really depends on the deal. But there are capital improvements we do to everything. And at a minimum, we're rebranding it to our management platform. That involves redoing the leasing office, monument signage, things like that. Because I think the least that we'll spend on a deal typically from a CapEx perspective, it's about 50 grand. But most of our value creation is going to come from the operational platform and marking those rents to market, better advertising, filling up vacant units. The stories kind of, I'll give you a couple quick examples. The stories of the deals that we've been targeting lately. We're closing on a deal pretty soon in the Atlanta MSA. And seller's a great guy. He built it. He recently completed an expansion, but he runs it from the liquor store next door. He runs it from his iPhone. He's the only employee. The owner is the employee. He's only there for like 2 days a week, 4 hours a day. He has no tenant insurance in place. His customers cannot sign a lease online, make a payment online, and his rents are about 25% below market. So that one, in year one, we're gonna layer in tenant insurance. We're gonna incrementally increase rents on existing customers slowly, but we're gonna do it. And we're going to take the expansion units that you just built, which are mostly empty right now, and fill those up through better marketing. So that's kind of our year one, year two value creation plan on a project like that. Now, sometimes we will actually drive occupancy down while driving revenue up. On the Green Bay example I gave you a moment ago, in June of 23, in-place rent when we closed on the property was about $70,000 a month. And occupancy was about 98%. Today, we've driven occupancy down to about 92%. And you might think, oh, that's not good. That deal's not going well. Well, on the other side of the coin, we've taken monthly revenue from $70,000 a month to over $100,000 a month. And we've done that through the ancillaries, through rent increases, through moving in new customers into a vacant unit at a higher rent rate than they were paying a year ago. So sometimes we'll drive occupancy down while driving revenue up. Other times we'll buy deals where instead of their rents being too low and we see a story to increase them, we'll buy deals where we see their rents are too high. They're not getting move-in velocity. They're not getting net rental activity growth. They're not getting occupancy growth because they're hanging their hats on a rent number that's too high and the deal's suffering for that. So we'll come in and we'll drop our asking rates in the first year and we'll drive that occupancy up and hopefully drive revenue up at the same time. And once we get to kind of critical mass in the high 80s, low 90s, we'll start increasing rents further from there. So it really depends on the deal as far as how we're growing revenue. And sometimes that can involve a reduction in physical occupancy. Sometimes it can involve an increase in physical occupancy. But regardless of which one it is, obviously we're always endeavoring to increase top line revenue.
Yeah, well, I mean, that's kind of a, really, pragmatic way to take a look at it. And I think people, too often when it comes to especially commercial real estate of any form and flavor, don't necessarily see the forest through the trees. It's, if you're looking at top line revenue, however you plug in that algebra that kind of gets you to that, again, within reason, and, certainly trying to be sustainable really isn't necessarily a bad thing from your perspective of saying, look, if we're going to maybe drive down, occupancy, well, again, bad, people from real estate, you always need to be at 100%. If you're not there, you're not doing something right. But if you brought in things like tenant insurance, if you brought in, rent increases and that, top line revenue is going up from where you started, and you have, again, a realistic pathway forward to make sure that you can bring that occupancy number up, then is it a bad thing? I think it's pretty clearly, no, it's not. So that's one thing, especially I think that might be a little bit more unique to self-storage that, I don't think that model would really play out too well in the, commercial multifamily space because, your revenue is, solely tied basically, you can only, if you don't have a tenant there to pay pet insurance, if you don't have the tenant there to be paying, parking fees, then maybe that model doesn't work too well. But that's definitely kind of an interesting aspect that you bring up of being able to kind of play with that to a degree to move that in. And, on a smaller side, maybe on the example you asked of the self-storage, I should have used my parents because they have had the same storage unit, I want to say, for about 30 years at least. I haven't lived at home for almost 20 years, and they definitely have room for it, but they have kept that same storage unit for easily 3 decades. So, again, that also kind of plays into this.
Personally, I'm guilty of that same sin. I had some stuff that we leased the downstairs of our office building. It's kind of an industrial area that we own to a third-party tenant. I had some stuff down there. I moved it to a storage unit that we unfortunately don't own, like 2 blocks away. And I have my stuff out of there in 4 months. And 18 months later, after 2 rent increases, I still have not found the time to get over there and donate it and give some stuff to my sister and put some stuff in my basement. Between a full-time job and 2 little kids, you just don't make the time for it. And it hits my credit card every month, and it's annoying, but it's not enough to put my lights out. And so there it sits. Just I've definitely paid for the value of my stuff at least once over in that 18 months. And that's
it's kind of like it's like the mosquito in your house versus like an alligator in your house, right? It's like it's annoyance, but it's not enough for you to all right, I really need to get something done with this.
Yep.
So one thing that I kind of would like to cover, I think is gonna kind of play in nicely to the end of this is, we talk a lot about management being really kind of the crux of this asset class, as opposed to a lot of other things. Management's really where you're going to see that appreciable top line revenue gain. It's where you're going to be able to create all of those increases in margins that are going to help this make to be a successful play. But in that, you talk about things like that one in Atlanta where the guy was running it from a liquor store that had no online rent payments, that you had to basically do it, pen to paper, and he only worked 4 hours a day. Well, with building out effective systems like that, it's not free. Having the development for the software, for the interfaces, for the API, for all that kind of stuff has to be a significant cost factor for this. So, how do you, is that something that you try to do in-house, or is there a degree of farming some of this stuff out to where you have a nice polished API for someone to say, look, just moved to the area, I'm downsizing, I X, Y, and Z, I need an apartment complex, boom, on the phone, done, not having, to make the velocity of the tenant a lot quicker to come in and utilize the service?
Yeah. One of my partners is a software engineer by training. And we've got a number of software platforms that are third-party software as a service platforms that we pay for and kind of white label. Other platforms we have built internally, customized. It's not a white label third-party deal. We built it ourselves. We use it ourselves. So our main third-party property management software or software program that we use is a program called Store Edge. And that's one of the larger property management software platforms in the country. It's kind of like a Yardi or an Appfolio, except for self-storage. And that integrates with our gate systems, with our financials. And that's really your top line data, your occupancy, your customer demographics, general ledgers, things like that. So the problem with Store Edge, though, among many, is it's only giving you, from a reporting perspective, a real a kind of snapshot in time report. So let's say you want to look at a summary today. You would pull a summary. It takes a while for it to load. And then let's say you want to look at trends. you have to export all that data into an Excel file, and you have to trend it out and make a graph. So we built an API into storage that we call Clear Insight, and it updates 4 or 5 times a day, so more or less real time. And we can monitor in our entire portfolio in a dashboard format all these different KPIs that we track: net rental activity, occupancy, delinquency rates, insurance penetration, monthly revenue. And not only can we track this stuff real time, but we can also graph it out historically. So you can pull a report. Let's say you want to look at Fund 2, for example. You can look at the historic revenue streams by month of Fund 2 since the beginning of time, since the fund launched. And then if you want to get a little more granular, you can drill down rather into the facility level performance. So if you want to know what our deal's doing in Comstock, Michigan, whatever metric you want to look at, you can pull that. And not only do we use this internally for our own monitoring and kind of gauging our performance, but we also give our investors access to the same software. So they can log in real time. And if they're wondering on their Saturday morning how Fund 2 is doing, kind of in between our reporting frequency, they can log in and see exactly what the portfolio is doing through that snapshot in time, but also look backwards at kind of historic trends. So we use Clear Insight. And then on the operations side, we also built a software platform that we call Market Sentry. And it's essentially a scraping software. And it crawls thousands of storage facilities around the country. And it scrapes out the street rates or the asking rates on various operators' websites. And it puts them into a database and it saves it. And we have millions of historic data points going back almost 10 years now since we started building the software out. And let's say, for example, you're underwriting an acquisition in Florida and you want to look at where rates are at from competitors to put into your model to kind of analyze whether your facility you're targeting is above market rents, below market rents. Well, you can pull down to the unit level. Let's say you want to look at what a 10 by 10 elevator access climate controlled facility is leasing for in Pensacola, Florida today. You can export all that data out and it shows you a graph. It's kind of like the MLS to a degree of self-storage. But what it'll also do is it'll go back years in time, depending on how long we've been crawling that submarket, and show you what historic rent trends have been. So let's say there's a supply shock in a market. You can see rents go down when all that new product comes online. Let's say, which unfortunately has been happening a lot lately, let's say a hurricane comes through, people's property gets damaged, they need storage. You can see rents and occupancies go up in the months following that hurricane. Now, if you're underwriting your new acquisition with that snapshot in time revenue stream, you might overstate your potential revenue because there was an event that caused that revenue to increase. So we can look at that historic revenue and we can normalize it. And we can not only make a more informed acquisition decision on deals that we're targeting, but we can also more effectively manage our in-place revenue post-acquisition by looking at our competitors' rates real time and analyze, what they're doing. If we're $150 a month on a 10 by 10, everybody else is at $120 and we're suffering on occupancy. Well, we got to lower rents to respond to the market, and it goes both directions. So those are a few examples of the software programs that we paid for. We pay for as a third-party service like storage, but also platforms that we've built, customized, and designed internally that we use to not only report to our investors, manage our KPIs, but also understand our competitors and what they're up to.
Yeah, no, that's part of what I find really fascinating about this is just how tech heavy it can be, which is awesome to see. Whereas other different types of markets and asset classes don't necessarily drive the operational aspects with so much data. When you're talking about different things, again, I just don't get the feeling from that. I'm sure there are some operators out there that are, kind of data scientists by trade almost. But again, that's one part I really find interesting about this is just how dynamic it can be with the technology. But to that point, where do you kind of find the biggest cost drain from this asset class in general? Is it, kind of the traditional model of tenant turnover? Is it, the ongoing sunk costs that you have just with the operations and tech licensing and things like that? Where would you kind of say is the biggest, what's the biggest shark in that pond that you constantly need to watch out for when it comes to ongoing cost with this asset class?
Yeah, on our so in your operating expenses, in your income statement, you've got controllable and non-controllable expenses. So and this kind of transcends asset classes, whether it's storage or multifamily or industrial, whatever the case might be. But obviously one big one is property taxes. And these are full service leases, not unlike multifamily, where like an industrial property, the tenant might be paying for the property taxes via a triple net lease, right? Yeah. In storage, that's not the case. So in the self-storage business, and one of the big risk profiles, among many things, is property taxes and understanding and quantifying those property tax bills and accruing for them in a worst case scenario. So what you don't want to do is think you're going to spend $100,000 a year in taxes on a deal. You buy it 2 years later, you get assessed at $150K, right? That $50,000 expense load you weren't expecting is a massive negative impact to your NOI and a massive negative impact to your overall value creation, right? You missed it by $50,000, you put a cap rate on it, you've got a big miss there. So we accrue for property taxes in a worst case scenario. Most of the time we're wrong in the right way. Sometimes we're wrong in the wrong way, but usually it comes out the other side lower than what we think. Another big one too, which again, we all talk about this quite a bit lately, but another big one that we didn't appreciate or didn't really watch as much maybe 4 years ago, but we watch a lot the last couple of years, is insurance. Mm-hmm. Insurance has become as much, if not more, of an expense risk than property taxes are. We're very fortunate that we rebid our entire portfolio on a master plan. We only saw about a 6% year-over-year increase, but that's been a major factor in a lot of folks just kind of seeing expense challenges. Is just these insurance premiums going through the roof? That's a big risk factor too. The other one I would say, outside of taxes and insurance, the other big one is our salaries and wages, right? We staff most of our facilities with an on-site manager, and certain markets, we cannot throw enough money at a candidate to get them to show up to an interview or show up to work. So we're constantly recycling. The labor market is very challenging across the entire economy, across all of our businesses. It's really tough to find and retain talent right now. And we're not migrating, but I guess experimenting with lighter staffing on a number of our stores. We're implementing kiosks where you can rent it on a screen to reduce some of our salaries and wages overhead. But that's been a big challenge the last couple of years, is not only that expense load in paying our employees, but also just finding somebody who actually wants to work. Hopefully that'll change in the coming quarters, but it's been like this for quite a while.
No, that's definitely surprising. One quick question on the insurance. Are you finding it hard? Would you say that it's the underwriting, at least for policies for self-storage, is more of a challenge on just the expense that the rate at which it is increasing, or just getting coverage at all, or is that kind of market dependent? I know at least from us down here in Florida, I mean, to say we have an insurance crisis is probably putting it a little mildly, especially with 2 major hurricanes that just ripped through specifically where I live in the Tampa Bay area. And checking the news this morning, might have another one hitting up towards Pensacola next week, which is incredible. Fun for the whole family.
Yes.
But again, is it really market dependent on that, or is it again just more of a cost play that you really have to keep an eye on when it comes to the insurance on these types of assets?
Yeah, I mean, the easy answer is it's all of the above. Obviously, we're seeing materially higher premium increases in our coastal markets than we are in, say, suburban Wisconsin, right? Not a lot of natural disasters happen up there. I guess you have some thunderstorms, some wind, hail risk, but it's not a coastal market where carriers are trying to reduce their footprint and their liability versus increase it. So our premium increases there have been much more nominal. I can't think of a single deal that we've underwritten the last couple of years where we just simply could not obtain insurance coverage. We're certainly paying more than we used to, but not getting it has not happened to my knowledge as far as I can remember. But our terms, though, like our deductibles have gone up. We have a deal not too far from you in Lakeland, Florida, and it was in the path of Milton, and thankfully the impact was relatively nominal. It's pretty far inland. But it's funny, you're reconfirming your insurance when a storm's coming, right? You should probably already know that by heart, and you're not really looking at it until something's bearing down on you. And that one, we have I think we have a 5% deductible with a $50,000 minimum. Mm-hmm. So if we have a $75,000 claim, it does not make sense to actually initiate a claim, because you're going to have a claim on your record. It's painful just for that $25,000, and it probably goes higher from there too. So thankfully the damage was pretty minimal, and we had some gate issues and some landscaping debris cleanup. But you people think insurance fixes everything, and especially on commercial properties, if you have a property burn or blow down, you're not in good shape necessarily because you have insurance. You're hiring attorneys. You're probably suing the insurance company. You're in a knife fight over the coverage amount. It is not just a ripcord that you pull and you get a massive check and you're a hero. So the premiums have gone way up and deductibles have materially increased too, for sure.
Yeah, absolutely. And again, that's something to definitely keep in mind when people are looking at this asset class, because I would think there might be a prevailing thought of people maybe that are taking this as a, kind of a first foray into self-storage, is that, oh, well, you don't have individual people living in this. Insurance has to be easier. And again, insurance is insurance. It's kind of a nightmare no matter if it's your own personal residence, whether it's your car insurance. People I think would, just go into with the assumption if you're investing in real estate, insurance is going to not be fun,
Yeah.
no matter what
Yeah.
asset class you're in. So again,
Absolutely.
yeah, we definitely covered a lot of really interesting aspects of this, from why the development play can be problematic with things like supply shocks, and a little bit of the unknown, and also with the repositioning, having that kind of data driven analysis that you look at to be able to kind of scrape everything and say, okay, here's really what can happen with this from a practical standpoint of something that is tooled up, ready to go, and what we can do with it. And also the different, I thought it was really interesting when you talked about the position of your top line revenue being kind of the core focus, and doing the equation of saying, well, if maybe we drive down that occupancy a little bit, if we have all these other things that are building into it, it can still be a net positive from our investment ethos of what we're doing, and obviously trying to get that as close to 100 as possible. But with that said, it's definitely been a little bit more of a different conversation that I've had with other people. A lot to do from the 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 utilization of these properties, on kind of how you have looked at the management being kind of the core focus of this, as opposed to some other people I've talked to. So with that said, kind of to wrap this up, for people that are maybe kind of looking at this as a new investment platform, or looking to identify and align themselves with an operator, what are some high level things that you think really people should take away from this as the points to drill down on and look for in an operator?
Yeah, and whether you're looking to invest in storage or multifamily, let's say that you've been listening to podcasts, you've gone to a few seminars, you're reading books on real estate investing. The best way to create wealth in real estate is to take action. Time is your best asset, and if you're hurrying up and waiting for kind of the perfect deal, the perfect set of market circumstances, this wealth creation game is very long and it's very slow. And my advice, I guess, initially would be to take a risk. If you're not positioned to buy your own storage facility, you're buying an apartment building, but you've got some money laying around and you want to get in the real estate space, take action and take a risk and start getting it deployed. There's never a good or a bad time to buy. There are just deals that have risk-adjusted returns, and there are deals that lack risk-adjusted returns. To actually answer your question on the operator component, one of the common themes that we'll see in various like webinars and pitch decks is you'll see a track record section. And in that track record, hey, look at all of our crazy returns that we put up on all these deals. We sold these deals, we sold these deals, we did crazy IRRs, crazy multiples. And I would look and focus more, if you're interviewing a new sponsor or a new operator you're considering partnering with, I would not pay a lot of attention to their home runs or their successes, because many times those successes were realized in an environment where everybody else was successful at the same time. If you bought a deal in 18 and you sold it in 21, you're a hero. Yep. Regardless of whether you had operational excellence, whether you delivered on your projections or not, you were saved by compressing cap rates, rising rents, and an historically low cost of capital on your debt. So the outcome probably went well. So when you're talking to new sponsors that you haven't worked with before, that you're considering deploying capital with, ask them about their worst deals. Like, tell me about your challenges. Tell me what hasn't worked. And then on the deals they've sold, they're showing you in their track record, understand when those were sold. So a deal that was sold in 21, for example, is much less of a data point than a deal that might have sold in the middle of 2024, right? Well into this new environment, higher rents or higher interest rates, kind of softening real estate fundamentals. but ask them the hard questions. Tell me about your failures and not so much your successes. And then another question that we get sometimes, but not nearly as often as we should be asking about the scenario where you can lose money in that investment. Ask the sponsor, tell me what needs to happen here where, first of all, I'm not getting the return that you've targeted for me. And by the way, all of our models are wrong, right? The model never goes like the deal goes. It always goes better or worse. You're never going to have a 5-year hold and deliver a 16.7% IRR like the model says, right? It's going to be better. It's going to be worse just every time.
It will be
understand what scenarios might need to happen where you could see a loss of principal. That could be an increase in cap rates. That could be a debt issue. Like, if we don't execute on X, Y, and Z, that could be a problem. And so much of that risk profile obviously is out of the sponsor's control, out of your control. But understanding the story high level of what would need to happen where you could lose money, I think is really important.
Great. Well, again, I think we definitely covered a lot of interesting aspects of this, and certainly I learned some stuff by speaking with you, which I always enjoy when I'm on a podcast. It's one of those things where I really enjoy doing these, and whenever I can learn something new, all the better, right? So if people are more interested in learning more about specifically your investments, and if you have opportunities for investment, where's the best place that they can reach out to you directly?
Yeah, we always love to talk about real estate. People can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or they can hit me on LinkedIn, which is Jacob Vanderslice.
Awesome. Fantastic. Well, again, really appreciate you spending some time with us today. It was great that we could finally get this on the calendar and get the interview done. Again, I would encourage people, if you're ever looking for opportunities for investment, always make sure that you're asking hard questions, just like Jacob said. It's well and good to look at someone and say, hey, look at all of my successes. But the first thing you want to do is, look at something, say, okay, this is great in a best case scenario, but what happens in a worst case scenario? Always be well-rounded in your research and your due diligence, because that is the first thing and the first kind of step that you need to take, is making sure you understand what you're doing. So again, Jacob, thanks very much for being on with us today. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.